Go ahead and talk about what we're going to talk about here. Oh, we got Dan from Minnesota, my old stomping grounds. So what are we going to talk about today? We're basically going to get ready for the week. We're going to start doing these stocks and coffees again every other week. And the weeks that I don't do these, I'll just put out a video. But today, to get started for the week, we're going to talk a little bit about the market itself, what to do when the market's volatile, kind of the mindset for bear markets and the setups we should be looking for right now. We have a toolbox of setups that we trade from, right? But not all of these setups are good for certain markets. And that's part of the skill of a swing trader, is understanding what the market's doing and applying the appropriate setups for that. You just don't want to use kind of like, if you're a carpenter, you got a tool belt, you're not going to use a hammer when you need to screw something in, kind of the same thing. So we're going to talk a little about that. Then we're going to get to the market analysis. What is the market showing us right now? What are the indexes showing us? A little bit of market breadth. We'll look at some of the key industries that we always look at and where they are right now. And then a few of the many stocks we're watching that we can kind of key in on this week once we have that outlook that we're looking for. It shouldn't be long. We'll get through this in about 30 minutes and get on with our relaxing, hopefully, or fun-filled Sundays. All right. Let's talk about it. So first, market volatility, bear markets. What should we be doing in these periods? I put out a little tweet a couple of days ago, and we'll just go through some of the 10 things I talked about here. These are more kind of mindset and how you should be trading overall in general. Number one, when volatility increases, especially in a bear market, there's this tendency to see these wild moves, and you become volatile as well in terms of trading too frequently. And what you'll find is most of the people who are trading too frequently are losing and getting crushed. And when we're in a bear market, you might take a little dip in your trading or in your results, but you want to be beating what the market's doing. If the market's down 20%, maybe if you're only down 5%, you're doing pretty good. And then when the market rebounds, you can crush it. What you don't want, if the market's down 20%, and if this happens a lot, for you to be down 30 or 40%. So decrease the frequency of your trades, be patient, look for specific things. And if that means you don't trade, this is specific to swing trading. With day trading, intraday trading, you actually sometimes want to up your frequency because all that volatility is good for you. But as a swing trader, we want to decrease the frequency, look at certain things. And if that means you don't put on a trade for a week, then you don't put on a trade for a week. We want to wait till we get the edges. So that's number one. Two, loosen your stops a little bit. Tight stops do not work when the market is volatile. There's a tendency to really want to protect yourself and use some really tight stops. But when you do that, you're going to get shaken out of a lot of trades because that intraday volatility is going to hit you. So loosen your stops a little bit. If that means you position size smaller, that's fine. And that kind of position sizing smaller lends to point number three: decrease your risk. If you have a $100,000 account and you usually risk 1% per trade, meaning, if you take a loss, you would lose $1,000. Take that down to 0.5%, so you only lose $500. If you're a $10,000 account, you usually risk $100 per trade. That's not position sizing. That's the amount you would lose when you get out. Maybe keep that down to $50 or $70. So decrease that risk a little bit. Point number four, narrow your watch list. What you'll find is, you guys have probably seen this in the last couple of weeks, almost everything moves together. So it really almost doesn't matter what you're watching. Everything's going to be up or down. There's some minor differences here and there that are hard to predict. But in general, most things are going to move together. So you don't need to be really keyed in on, 200 different stocks. They're all going to be moving pretty much together. Pick a few stocks here from different areas in the market, different sectors, different industries, of course, the indexes as well. Maybe keep that list down to 10 or 20 stocks that you're really keyed in on, and focus on those. Point number five is you can hedge. Don't get too caught up one way or the other. Take some shorts, take some longs. If you trade options, there's a lot of other types of hedging strategies. You can hedge by the setups you trade different setups that aren't going to be correlated together, stocks that are not correlated together. So hedging is a good strategy used during these markets. Whereas if you're in a market where you really are confident in what the setup is in the overall market, you can, get a little more aggressive in just one direction. Point number 6, focus on key support and resistance levels. You'll find, especially when the market really gets crushed, that the bounces or where the market starts to stall is usually set up around these support levels, and then where it bounces to will be right at the key resistance levels. So pay attention to that. During this period, especially, sometimes you're not trading too frequently. Like, what do I do right now? One of the things you should be doing is tracking stocks that are showing relative strength and relative weakness. And the reason we do that is stocks that are showing relative strength when the market really does bounce or get back on trend, positive trend. Those stocks that have shown relative strength are generally have a good chance to lead the market. And one caveat to that is, of course, stocks that are kind of quote unquote safe stocks. Those are going to show relative strength to the market. Those aren't the ones that are going to lead when we come out. So don't count the kind of safety stocks like, the big Dow companies, the Pepsis, the Cokes. We're not talking about those. But say, you're looking at growth stocks, you're looking at tech stocks, the ones that hold up really well. Those are the ones that will tend to do good going forward. Point number 8, this is an important one. You guys have probably seen this many times in the last couple of weeks in the mornings or in midday, is ignore the intraday fake outs. There are a lot of intraday fake outs. These things are good for intraday trading, but for us, don't get too caught up if it looks like the market is bouncing in the morning. As we've seen, these things can fake out quite a bit. So maybe you can take a shot here and there, but don't bet the farm on what you're seeing intraday. The opens and the closes are what are really important for us in terms of seeing trend reversals or trend continuations. That leads to number 9, wait for confirmation. If you miss the first move, that's okay. Or if you miss a little bit of the first move, that's okay. We want to see confirmation, and then we can jump in. And point number 10, don't get stressed out. You can't control what the market's doing. You can only control yourself. So relax, know that you're looking at the right things, know that you're controlling your risk, and then just trade comfortably. So those are 10 things. I think if you're following these things, you're going to have the right mindset, and you'll probably be beating what the market is doing. And if you decrease your frequency of trades, you're probably crushing what the market is doing at that moment. All right. If you guys have any questions, let me know. And just to make sure we haven't frozen up here because I haven't seen any questions, let me know if you guys can see me or hear me okay. And of course, go ahead and ask questions. Let's get to the market analysis. So let's take a look at SPY, the Qs, IWM. It's pretty much the same thing as we've been talking about. A lot of you are swing trading members here, members of the Swing Trade Report. And if you're not, you can go to Bulls on Wall Street and join. Here's the report that was for Friday. There's a video, a little summary, the stocks we're watching, the Discord chat room as well. But let's talk about it here. We've been talking about this for a while. We are in an overall topping pattern. Essentially, what we're seeing is a head and shoulders topping pattern. And I'll do one of my little ugly drawings here to illustrate that. Essentially, what a head and shoulders is, many of you guys know it already. You get that one high here, you get the breakout, but the breakout starts to fail. And usually what happens here, if we're thinking about why this is happening, we get the breakout that fails. So many people were conditioned to play bounces and expect that the market's going to go higher. So that we get another weak bounce attempt, and then that fails and we get the continuation down. And now you have yourself a topping pattern. And here's where the topping pattern breaks. This drawing is essentially what we see in the market right now. You have that left shoulder, you have the top where it looked like we were breaking out. You have the downtrend, the bounce. There were actually two, and these always aren't clean, but we could call this the right shoulder or this the right shoulder. And now we are in this part right here. And you can see we kind of broke that right in here. And now we are in the downtrend. So we're essentially in a downtrend phase of a topping pattern. The question is, one, when does this thing end? And eventually it will end, but we don't know right now. Does it end here? Does it end here? Does it end down here? We'll continue to monitor that and look for signals. Remember another thing that some of the most powerful bounces that we see are not actually in bull markets. They're in bear markets. So we should be aware of that. We've already had, this was a pretty powerful bounce here when we went from 415 up to 462. That's pretty strong. So maybe we bounce here next week or the week after, and we'll be monitoring that for sure. But we are definitely in a topping pattern. If we look at the Qs, even more pronounced. I have this line to the 2020 high, but the actual break of the topping pattern is more up here. And we're in that downturn continuation. This is a much cleaner head and shoulders pattern. So same thing. And you can see here, there's a lot more room that this thing could go, right? If we look at where the Qs were pre-pandemic, that's way down here at about 238. So a lot of room, there's about 50 more points till we hit the pre-pandemic levels. So, but again, in the meantime, we could see some bounces. So that's Qs, and then IWM, something very similar, a little different pattern, but we are still in that same trend. So essentially, that's what you should be thinking. We are in, you always want to know where you are in terms of the overall pattern of the market and trade accordingly. So we're in a topping pattern, continuation, downtrend continuation of that topping pattern. And we know then there are certain specific setups we should potentially be trading when we are in this phase of the market. We're going to talk about that in a second here, the 3 key setups that we should be watching when we're in this area. But right now, let's talk about market breadth real quick. 2 things we can quickly look at. I look at a bunch of other things too, but if you want to get an idea of what the market is doing, you can use a T2108 indicator on TC2000. That's measuring stocks above their 40-day moving averages. If you don't have TC2000, you can go to some other platform. Stockcharts.com has an indicator that stocks above their 50-day moving averages, their 200-day moving averages. You can use those as well. But if you have TC2000, you can use a T2108. Now, what we want to look for here is a positive divergence as the market is going down. We were seeing that a little bit before, but not anymore. So we can see the market is getting crushed, and so is the T2108. If the market starts to go down and we see T2108 is not going down as fast, that might be a positive indicator. We're not seeing that right now. So right now, T2108 is basically confirming, and that's what we're using this for either a confirmation indicator or to look for divergences. Right now, we're seeing confirmation of what's going on in the market. The other thing we can use for potential reversals is I like to see when the market is really extended to the downside, both in price action and sentiment. And if we look at, this is a really good indicator to get that here, the fear and greed indicator on CNN. You can see here, it's sitting at extreme fear right now. And oftentimes when you see that, so much fear in the market that we're due for a bounce. I would like to see this thing get more oversold. It's been sitting between like 10 and 20 for a while now, but if next week or the week after, this thing could get down to, between 0 and 5, that's the spot where we might start to see some extreme fear, and then we could play a bounce. We haven't really played a bounce yet for us over at Bulls on Wall Street, but if we get that next push down here, which we're starting to get, we had a little reversal at the end of the day, Friday, but if this thing next week starts to go down, maybe we test the 2020 range right here around 360, we'll say, on SPY, we'll see this extreme fear indicator get really low here, and we might be due for a bounce at that point. We could actually, for the first time in a while, start to get aggressive with potential bounce plays. Okay, I've got a question here from Ed. If you see the whole COVID move on the SPX, we are just in the 38 Fibonacci. Is this move just a long-term bull flag? Maybe it could be long-term, but we're not really concerned with long-term right now. And if we look at the weekly here, there's still room, right? And we could be in this kind of bullish trend, but testing maybe this range, same range here. You're right, and that could be corresponding with the 200-day moving average. But this doesn't really give us a good signal for the shorter term swings that we're trading right now. But you're right in your analysis of that longer term. Okay, all right, if you guys have any more questions, just mention them in the chat box there. All right, let's talk about, I skipped around here. Let's talk about now the 3 key setups we're looking at. We know the market is in this kind of topping pattern, right? So there's 3 key setups we are watching and essentially trading right now. One is the dead cat bounce. That is a short setup, and essentially all that is, when the market starts to get extended to the downside and you get a reflex bounce coming into a resistance level, one of two things is going to happen. Either you're going to break that level, and that what usually is going to happen there is, and you're going to get a nice secondary move, or you start to fail at that level. And that's the spot that's very good for short setups. When you start to fail at that level, that's the dead cat bounce. You can play it either as it starts to fail, or if you're waiting for more confirmation, you can wait for a break of the low. The problem with waiting for the break of the low is it gets a little extended to the downside already when that happens. So I like to try to take them when it's starting to fail at that resistance level. So that's one of the three setups we're really keyed in on. That's the dead cat bounce. And if we just pull up some stocks here, let's just pull up, say, Zoom. Zoom's had dead cat bounce over dead cat bounce here since it actually topped before the market did, just before 2021 hit. But essentially, that's what we've seen here, right? Let's start in October, late 2021. You see bounce here, failure at the 50-day moving average, dead cat bounce. You have another bounce here, failure at the 9 EMA. This was, continual failure at the 9 EMA, setting up the secondary move down. You had a little stronger bounce here, but then failure, and I've got this arrow here when we were looking at it, failure at the 50-day moving average, next move down. So this has essentially been dead cat bounce after dead cat bounce. So that's been one of the bread and butter setups in the market. Setup number two would be a rubber band setup. And that's essentially before the dead cat bounce, where you're really extended to the downside, you're due for a bounce, and you're not predicting an overall trend reversal, just that there's a bounce that you could play. And like say you have a stock that was at 50 and has gone down to 20, even if it captured on the bounce, captures a little bit of the move that it went down, maybe it makes goes up to 30 and it was at 50. That move to 30 is a 50% move for you. So that can be, even though in the grand scheme of the stock it looks like a small bounce, it can be a 50% move for you. If we just look at Zoom here, when Zoom bounced here at what was it, about 90, 94, it bounced all the way to 130. So that was in the grand scheme of things, it looks very weak. But if you were trading this, you might have got a 30% move on what looks like a weak bounce here, but it's actually very powerful. So these rubber band setups, very good in these bear markets when the stock gets extremely oversold. And that's actually what we're looking for next week and the week after. If we get another push down, we might have some rubber bands that we could potentially play. Third setup would be a continuation pattern where you get the rubber band, and instead of failing and turning into a dead cat bounce, it continues higher. And then you just play that secondary move here. So right now, those are essentially the three setups you're looking at. Rubber band, dead cat bounce, and then continuations, either the reversal continuation or even downtrend continuations as well. So three setups you should be keyed in on right now. There are three setups we're looking at going into next week. All right, so we've got what we should be doing in a bear market or a volatile market, the three key setups, 10 things to do. We've analyzed the market now. Now let's look at some industries going into next week, and then some stocks that we can be watching as well. Let's start with energy and metals because they had been leading the market for a while. Energy is still leading the market, and look at that. If you just looked at energy, you would never know that the market's getting crushed, right? Because it's in a downtrend here. So definitely, if you're looking at one area of the market to think about in terms of trends on the long side, outside of the weak plays that are rubber band bounce plays, but actual trend continuations, you would be looking to energy, and that's essentially the only area in the market right now. Now let's go to metals. Metals were in that spot where they were just moving even stronger than energy, but now metals have taken a big dive here. You can see XME has gone from 66 down to 50. XME, along with a lot of the metal stocks like say X here, are testing their 200-day moving averages right now, but definitely not downtrend continuations at this point. If they were to start to show some strength here and get back up over the 50-day moving average, then they would be. Potential maybe rubber band bounces here, but outside of that, not a kind of trend play. And then financials, which were showing relative strength a while ago, getting crushed. They're in the topping pattern. So essentially, we're looking at the same thing in this area that we're looking at in the rest of the market. That is dead cat bounces, rubber bands, and then continuation. So right now, really beaten down, potentially, but then if it were to bounce and fail, we could look for shorts for in stocks in this area. Home builders, essentially the same thing. Overall, huge topping pattern in home builders, and still a lot of room to fall here. And especially with rising interest rates, we know that that could really impact home builders as well, and real estate. Retail was holding up really well until last week when it got crushed after Target announced that inflation is hitting the consumer. And you can see here, retail itself has been hit really hard recently. So again, really good candidate for rubber band bounces and dead cat bounce shorts. XLI, we're essentially seeing the same pattern everywhere we look. So there's not much change here. We can just go through these real quick. Same pattern here. Airlines, which is actually showing a little relative strength here. And we'll see how summer travel impacts the airlines. But it is showing relative strength. If you see some of the other areas that are going like this, airlines have basically gone like this for a while, and a lot of back and forth. So not something I'd look to trade right now, but it is worth noting that it is showing some relative strength. And then some of the tech areas, let's look at bigger tech with semiconductors and communications. Then we'll go to more of the growth areas, more lower float growth areas. But semiconductors here actually holding up decent compared to the Qs. Is beaten down, but maybe showing a little bit of relative strength. Then if we look at communications has been crushed. You can see the difference between semiconductors here and communications. Communications hit much harder here. You can see the stocks that make up communications: Netflix, Twitter, Facebook. Obviously, these things have been hit really hard, and they're very heavily weighted in that area. Let's look at software. Software hit even harder. This is where a lot of the growth stocks reside, a lot of the big moves since the pandemic low, and now we've given up much of that move. Very good candidate because it's so beaten down, very good candidate for rubber band setups and the dead cat bounces here. So obviously this area, we're watching quite a few stocks in this area. And related to that would be ARK and social media. Let's just look at social media real quick. Also been crushed. And then the ARK ETF, which has a lot of growth stocks, look at that, even worse here. You can see the move here. It was the pandemic leader at 160 here, and all the way down to 42 in a very short period of time. Now, the one thing about ARK is when the market tanks, ARK tanks much more than the market does, as we've seen here. But when the market bounces, it also bounces much stronger than the market. If the market were to go up 10%, I wouldn't be surprised to see ARK go up like 30%. So definitely an area we should be watching for bounces, no matter how weak it is. Okay, so those are some of the industries we're watching. Now let's hit some stocks we're watching to start the week. There's a lot more stocks we're watching, but these are some ones we can key in on here. AK has a question here. While we wait for the bounce, is it a good idea to go short? I wouldn't go short when we're already extended at a downside, but when we get a bounce and we fail at resistance levels, that's the best time to go short. Unless we just consolidate and go and start to fall, then that might be a good spot. Andrew's asking any key index levels you see for long-term dip buys. Well, we pointed out before on SPY that 200-day moving average for long-term, Andrew. Let me pull up the weekly here. I forgot who was talking about the long-term. I think it was Ed. But if we pull back here, if the market were to pull back to about the 200-day moving average, which also corresponds for SPY, testing that pre-pandemic high, that might be that's the spot I'm watching for longer-term plays. If we can pull back there in the next few months, maybe that's a spot where you start nibbling. You never know exactly where it can go, and as we've seen, supports can break down. But that might be a spot where you want to nibble a little bit for potential long-term plays. Aman wants me to look at AMD, which is a semiconductor stock, one of the big guys. basically looks exactly like SMH, and it's heavily weighted in that ETF. But we can see here, maybe it's a rubber band bounce play. It has shown a little relative strength here. To really like it as a trend play, I'd want to see it get back up over the 200-day moving average, and then the 50-day moving average would start to curl up. It's always a little iffy to make it kind of a trend play when the 50 is under the 200, but it would start to curl up here if we got above the 200-day moving average. All right, let's look at some of the stocks we're watching to start the week. We got Spotify, Zoom, Apple, Amazon, BSY for kind of the growth and tech plays, and there's a lot more we're watching, but we'll talk about these right now. Let's go to Spotify, Zoom, and BSY since they're more of the smaller, lower float group growth stocks. Here's Zoom, which we are all on right now. You can see here this was the post pandemic darling, one of the leaders, right? When everyone was staying at home. But look at what has happened now. It has been crushed. Now, what I like about it is we don't talk about fundamentals much, but let me pull this up here. As you can see, the percent share held by institutions has been increasing. And if we pull up the revenues and growth here, let me just pull up one of my lists here and you can see it. We're zoomed here. You can see here revenue growth over 50%, earnings per share growth over the last 4 quarters 700%, and it makes money, 1.4 billion. So it's not like a lot of the tech, some of the big names are losing money. So when we think about that and how much it's been beaten down, this is one that could eventually get on a good trend. But in the meantime, if it were to move one more leg down, Zoom's going to get crushed as well. And that could happen very quickly. Look, seems far, 90 to 60, but as you can see, we can see how quickly it went from 125 to 90. So this thing could push down very quickly. And if it were to test this level, maybe it bounces there. So we're watching Zoom very closely now. We could get in early on a information. Spotify is also another one that has good revenue growth and earnings. And if we look here, here's where its kind of post IPO low was right here, and it tested that level and broke down to remount that level. So watching that this week, if it remounts that level, we could see a move to the 50 to make a stop, and you get 4 to 1 on that trade. So watching Spotify very closely. Apple put in a hammer on Friday, which can often signify a reversal. You can see here this kind of hammer pattern where it was all the way down at 132, closed at 137. Maybe this is the rubber band play for Apple. So we'll watch that. At the end of the day, not as pronounced as Apple, but I'll be watching to this recent high here, and then maybe at that point we test the gap down. This was an earnings gap down here. We could test that at 2,600. So you could get a potential nice trade there. In Amazon, I think I already went over BSY. BSY, another one, software stock, growth stock that has good revenue growth and earnings growth. Overall pattern is not great, but we can see also this tested its IPO low and held. And oftentimes when they hold their IPO low, that's the extent of the down move. And watch this for a lot of the growth and IPO stocks, the stocks that have IPO in the last 2 or 3 years. A lot of them are testing their IPO lows and bouncing off those levels. So watch that very closely. Then retail has been crushed recently. Let's look at Target and Costco, and then there's some smaller retails as well that have done the same thing. You can see here the big gap down for Target could be an overreaction. Whenever you see a big gap down, what I would watch here for Target is if it can hold here and it put in a green candle on Friday and then pull into the gap range here. Even a move that doesn't even get half of that big gap would be a nice trade. So, if we enter here around 168, maybe target this range here at 175, we're talking about 17 points, and we'd probably be risking about 5. So you get 3 to 1 on the trade. Similar setup with Costco here. The gap down's not as pronounced, but still a big move down, and maybe we get a rubber band setup here. It's so extended to the downside. So these are some stocks that the stocks listed as A here are all stocks that have been really beaten down. Now let's look at a few that have shown relative strength, and these are in the big biotech companies and energy. So Lilly, Pfizer, and AZN. So let's look at Lilly here. Look at that, nice trend. We would never know that the market has been getting crushed and growth has been getting crushed. Eli Lilly, very strong here, holding its 50-day moving average. We have Pfizer with a very similar pattern here. See these higher lows, meaning it is still in an uptrend. And then some of the energy stocks, there's MRO, had pulled back to the 50-day moving average, holding, and now has rebounded to 9. Maybe a little extended, but we're seeing higher low after higher low. So whenever it looks extended, makes a higher low and makes that next leg higher. And that's pretty much the play for all of these energies. Here's APA here. CVX pulled back a little more and now is holding its 50-day moving average as well. And then at Halliburton here, let's take a look at HAL. Maybe not quite as strong here, but still making higher lows here and still on trend. All right, guys, so that's what I wanted to cover today. You guys, thanks for joining here. You guys can get a hold of me anytime. Here's some contact information. My email, singhjd1@aol.com. Of course, Bulls on Wall Street. And if you're interested, you can join the Swing Report here as well. That's bullsonwallstreet.com, swing trading. My own personal website, Paul J. Singh. Follow me on Twitter. That's where we went over this post that I had here. If you're not already, that's Paul J. Singh as well on Twitter. And then on Instagram, I post in stories almost every day, videos of what's going on in the market. That's the real Paul J. Singh. All right, guys, thanks for joining me. I'll be doing another one of these probably in about 2 weeks. And then in the weeks I don't do this, keep an eye out, join Bulls on Wall Street's email list, and you'll get the weekly swing report for free. That'll come out next Friday or Saturday. All right, guys, this was great. I will see you soon. Enjoy the rest of your weekend. Talk soon, guys.